You are sitting in the dark, wood-paneled office of an estate lawyer. You are wearing a black suit. It has only been a few weeks since the funeral. You are grieving the loss of your parents, the people who worked tirelessly for 40 years, sacrificing their own luxuries to build a life, to pay off their mortgage, and to leave something behind for you and your children. They always told you not to worry about the future because the house was paid off. But they believed they were leaving you a legacy of security. The lawyer opens a thick manila folder. You expect to be handed the deed to the family home, the keys to your financial freedom, but the lawyer does not hand you a deed. They hand you a piece of paper with a number on it that makes your blood run cold. It is a tax calculation. The lawyer explains that in order to transfer the title of your parents' assets into your name, the estate must first settle its final bill with the Canada Revenue Agency. You look at the number again. It is $350,000. You tell the lawyer there must be a mistake. Your parents were middle class. They didn't have $350,000 in the bank. They just had the house, a small cottage they bought in the 1980s, and some modest investments. The lawyer looks at you with a mixture of pity and professional detachment. They explain that the Canada Revenue Agency does not care if you have the cash. The tax bill is due. And if the estate does not have the liquid cash to pay the government, you have only one option. You must sell the family home, the cottage, and everything your parents worked for, just to pay the taxman. You did not inherit a legacy, you inherited a tax liability. Welcome back to Canada Property Watch, where we expose the hidden financial machinery designed to systematically extract wealth from the Canadian middle class. In our last investigation, we exposed the exit tax, showing you how the CRA is auditing and seizing the equity of homeowners while they are still alive. The response to that reality was overwhelming, but today we are looking at a system that is even more unforgiving because it targets you when you can no longer fight back. Today, we are exposing the death tax. This is the ultimate trap of the Canadian financial system, a combination of deemed dispositions, probate fees, and the new, devastating 66% capital gains inclusion rate. The government has figured out that the greatest transfer of wealth in human history is about to happen as the baby boomer generation passes away, and they have quietly rewritten the tax code to ensure that the largest beneficiary of your parents' hard work is not you, but the federal government. To understand the sheer brutality of the Canadian estate tax system, we first need to dispel the biggest myth in the country. Politicians will frequently look into the camera and confidently state that Canada does not have an inheritance tax. This is a brilliant piece of political wordplay. It is a lie by omission. We do not have a tax called an inheritance tax. Instead, we have a mechanism called deemed disposition on at fair market value. And mathematically, it is far more destructive. When a Canadian dies, the tax code pretends, for one terrifying moment, that exactly 1 minute before their death, they sold every single thing they owned to the open market at current prices. They did not actually sell anything. No money changed hands, but the CRA taxes them as if they did. Let us walk through the math of a typical middle-class tragedy playing out across the country right now. Imagine your parents bought a modest secondary property, perhaps a small cottage or a rental condo, but back in 1990 for $100,000. Over the last 3 decades, as the Canadian real estate bubble expanded, that property ballooned in value. Today, it is worth $1.1 million. When your last surviving parent passes away, the CRA triggers the deemed disposition. The government looks at that property and says, "Congratulations, your parent just made a $1 million capital gain on the day they died." Under the old tax rules, 50% of that gain was taxable. It was painful, but manageable. But under the new federal budget of 2024, the rules changed. Now, any capital gain over $250,000 is subject to a 66.7% inclusion rate. Because all the gains of a lifetime are forced into a single tax year, the year of death. Almost the entirety of that $1 million gain is hit with the highest possible inclusion rate. And the estate is now facing a tax bill of roughly $350,000 on that single property. But where does the money come from? The CRA demands payment in cash by April 30th of the year following the death. The property is worth $1 million, but you cannot pay the CRA with bricks and drywall. The estate is what accountants call asset rich and cash poor. As the executor, you go to the bank to ask for a loan against the property to pay the tax. The bank refuses. They will not lend money to an estate in probate. And they certainly will not lend money when the primary asset has a massive CRA lien looming over it. You are trapped. The clock is ticking. The interest on unpaid CRA debt compounds daily. You are forced to put the property on the market, but you are a distressed seller. The buyers know it. The real estate agents know it. You have to accept a lowball offer just to close the deal before the CRA begins seizure proceedings. And by the time you pay the real estate commissions, the legal fees, and the massive tax bill, the generational wealth that your parents intended to leave you has been effectively cut in half or worse. The government forced the sale, the government took the lion's share of the cash, and your family legacy is gone. This deemed disposition does not just apply to real estate. It applies to everything. It applies to non-registered investment portfolios. It applies to shares in a private family business. If your parents spent 40 years building a local plumbing company or a successful restaurant, the CRA deems those business shares sold at fair market value upon death. Families are being forced to liquidate successful job-creating small businesses, firing employees and shutting down operations, simply because the children cannot afford to pay the deemed disposition tax on the company their parents built. The government is literally taxing Canadian small businesses to death. And the devastation does not stop at capital gains. We must now talk about the RRSP trap. For decades, Canadians were told by the government and the banks to diligently put their money into registered retirement savings plans. It was the ultimate middle-class financial advice. Defer your taxes now, build a massive nest egg, and draw it down slowly when you retire in a lower tax bracket. But what happens if you die before you spend it? If a single parent or a surviving spouse passes away with $500,000 left in their RRSP or RRIF, the entire amount is deregistered immediately. The CRA treats that entire $500,000 as ordinary income earned on the final day of their life. It is added to the top of their final tax return, pushing them into the highest marginal tax bracket, which in many provinces is over 53%. The government instantly confiscates more than half of the retirement savings your parents spent a lifetime accumulating. You thought that money was for the grandchildren's education. The government decided it was for the federal treasury. If you are listening to this and thinking, my parents only have their primary home and the principal residence exemption will protect us, you are walking into the next phase of the trap. Yes. But the principal residence is generally exempt from capital gains tax upon death, but it is not exempt from the provincial estate administration tax, commonly known as probate. Probate is the legal process where the court validates the will and confirms the authority of the executor. You cannot sell the house or empty the bank accounts without a probate certificate. And the provincial governments charge a massive fee for this stamp of approval. In Ontario, for example. And the probate fee is roughly 1.5% of the total value of the estate. If your parents' home is worth $1.5 million, which is an average detached home in Toronto or Vancouver, the probate fee alone is $22,500. That is cash that must be paid to the provincial court up front, before the court will issue the certificate, before you can sell the house to get the money to pay the fee. Families are putting probate fees on their high-interest credit cards just to unlock their own inheritance. It is a hostage situation sanctioned by the state. To escape this hostage situation, many aging parents try to outsmart the system. They listen to advice from friends or something they read on an internet forum, and they make a catastrophic legal mistake. The most common and most dangerous mistake is adding an adult child to the title of the home as a joint tenant. The logic seems sound. If the parent and the child are both on the deed, when the parent dies, the house automatically transfers to the child through the right of survivorship, bypassing the court, bypassing probate, and saving $20,000. It sounds like a brilliant loophole. It is not a loophole. It is a financial suicide mission. The moment a parent adds an adult child to the title of their home, the Canada Revenue Agency considers it a disposition of half the property. If the child does not live in that home as their primary residence, the parent has just triggered an immediate capital gains tax event on 50% of the home's appreciation, payable in the current tax year, while they are still alive. But the disaster goes far beyond taxes. By putting your child on the title, you have given them legal ownership. Now, if that child gets into a car accident and is sued, the parent's house is an asset that can be seized by the courts to pay the judgment. If the child gets divorced, the child's ex-spouse can lay claim to half of the child's share of the parent's house. If the child declares bankruptcy because their business failed, the bankruptcy trustee will force the sale of the parent's home to pay the child's creditors. Parents are risking homelessness in their 80s to save their kids a probate fee. And the banks love this, the lawyers love this, and the CRA loves this, because it creates a tangled legal mess that almost always results in penalties, forced sales, and massive legal billing. We also need to address the vulnerability of the principal residence exemption itself during the final years of life. In our last video, we exposed how the CRA audits change of use. This becomes acutely dangerous when a parent ages and has to move into a long-term care facility or a nursing home. Often, but the family does not want to sell the house immediately. They want to keep it in the family, or they rent it out to cover the exorbitant costs of the nursing home. But the moment the parent moves out and stops ordinarily inhabiting the property, the principal residence exemption is in jeopardy. If the property is rented out, it becomes an income-producing asset. When the parent eventually passes away 5 years later, and the CRA will demand an appraisal from the date they moved into the nursing home, the growth in value during those final 5 years is fully taxable as a capital gain, subject to the new 66% inclusion rate. Families are completely blindsided by this. They assume the family home is always tax-free, but the CRA's definition of a home expires the moment you are forced into medical care. So, how do the ultra-rich avoid this? Or how do the billionaires and the political elites transfer their massive estates without being hollowed out by the deemed disposition and the 66% tax trap? They use structures that the middle class is never taught about. They use trusts. If you go to a high-end Bay Street law firm, they will not advise you to put your child on the title of your home. They will advise you to utilize an alter ego trust or a joint partner trust. These are specialized legal vehicles available to Canadians over the age of 65. You transfer your assets, your home, your investment portfolio, your cottage into the trust. You retain full control of the assets while you are alive, and you receive all the income. But because the trust technically owns the assets, when you die, you do not own anything. There is no deemed disposition on your personal tax return. There is no probate fee because the assets do not flow through your will. And the trust simply continues to exist, and the beneficiaries, your children, take over the management of the trust according to the rules you set in stone. The assets pass seamlessly, privately, and without the immediate devastating tax hit. But the government does not want the middle class using these tools. They make the rules around trusts incredibly complex, and the legal fees to set them up and maintain them can be tens of thousands of dollars. And the system is designed so that the barrier to entry for asset protection is so high that only the top 1% can afford the armor. The middle class is left exposed on the battlefield, armed only with a simple will, waiting for the CRA artillery to wipe out their life's work. Even standard family trusts, which were once a staple of middle-class tax planning, have been quietly neutralized by the government. And with the CRA instituted the 21-year rule. This rule states that every 21 years, a family trust is deemed to have sold all of its assets at fair market value, triggering capital gains taxes even if nobody died and nothing was actually sold. It is a ticking time bomb designed to force the liquidation of family wealth at least once a generation. You cannot simply park assets in a trust forever to avoid the taxman. The government has ensured that the clock is always running, and the bill always comes due. This relentless extraction of generational wealth is fundamentally altering the social fabric of Canada. The unspoken promise of the Canadian dream was that each generation would do a little better than the last. The parents would struggle, they would buy a home, they would pay it off, and they would pass that foundation to their children, giving them a head start. That cycle has been broken. When the current generation of young adults cannot afford to buy homes because of the massive debt bubble and the interest rate crisis, their only hope of ever achieving financial security was inheriting the family home. But the death tax ensures that the home will likely have to be sold to satisfy the CRA. The wealth is not transferring down to the children, it is transferring laterally to the state. The government is using the final tax return of the deceased to aggressively redistribute the equity of the middle class into the black hole of federal debt. If you are a parent listening to this and you want to protect your children from this nightmare, you must stop relying on the financial advice of the past. A simple will is no longer enough. You need to engage in defensive estate planning immediately. First, you must quantify the liability. You need to sit down with a tax specialist and calculate exactly what your deemed disposition tax bill will be if you were to pass away tomorrow. Look at the capital gains on your secondary properties. Look at your RRSP balances. Calculate the new 66% inclusion rate. Calculate the provincial probate fees. Get the terrifying number on a piece of paper. You cannot fight an enemy you have not measured. Second, you must solve the liquidity crisis before you die. The cheapest and most effective way for the middle class to pay the CRA's death tax without selling the family assets is permanent life insurance. If your tax liability is estimated to be $400,000, you purchase a joint last-to-die life insurance policy for $400,000. The premium is pennies on the dollar compared to the tax bill. When the second parent passes away, the insurance policy pays out tax-free cash directly to the children within weeks. The children use that cash to pay the CRA. The estate is settled, the taxman is satisfied, and the family cottage, the family business, and the family home are preserved intact for the next generation. The insurance company pays the government, not your equity. Third, you need to have the agonizing, uncomfortable conversations with your family right now. Do not leave your children in the dark. Tell them where the assets are. Tell them what the tax liability will be. And introduce them to your accountant and your lawyer. The worst time for a family to learn about the complexities of tax law is while they are grieving and organizing a funeral. Silence is the greatest ally of the Canada Revenue Agency. The Canadian government is quietly relying on your ignorance. They are banking on the fact that you will be too busy living your life, paying your bills, and trusting the system to look closely at the exit fees. They want you to believe that your wealth is secure. But the legal architecture of the death tax has been carefully constructed to ensure that the state is the ultimate silent partner in everything you own. They take a cut of your income when you earn it. They take a cut of your purchases when you spend it. They take a cut of your property when you sell it. And when you finally close your eyes for the last time, they calculate the total sum of your existence, apply a 66% inclusion rate, and demand the largest check of all. You spent your life building a fortress for your family. Do not leave the back door wide open for the tax auditor. Subscribe to Canada Property Watch. We are tracking the legislative changes, we are decoding the tax brackets, and we are giving you the unvarnished truth about how to survive the greatest financial squeeze in modern history. The media won't talk about it, the banks profit from it, and the government depends on it. Protect your legacy. Call your lawyer. And never underestimate the reach of the CRA. We will see you in the next investigation.